Hi, I'm Dave Knight with the Dave Knight Real Estate Team, and we love helping people buy and sell homes here in Southern California. Today's topic has to do with questions that I get quite a bit, and it has to do with capital gains when selling a property, and specifically, how do you avoid capital gains when you sell one of your properties? So to preface this conversation, I want to begin by saying that I'm a realtor, not an accountant. So you need to verify all of this information with your accountant and strategically work with your accountant to help you best figure things out. Now what I'm going to do is I'm going to explain a situation and situations that I see quite a bit that will really help give you direction on how to avoid paying taxes, specifically capital gains taxes, when you sell a property. So let's work off of these numbers. Let's pretend you own a property today that's worth, we think, $800,000. So if we were to go on the market today, we think that it would sell for $800,000. Now, congratulations, you bought it at a great deal. You bought it for $400,000 back at the downturn. And you bought it in 2009, 2010, and you've got a lot of appreciation on this property, and you're getting ready to sell it to buy something else. Well, how much of that $400,000 in appreciation are you going to end up paying in capital gains? Now, one thing you get to subtract is your closing costs. So let's say at $800,000 you sell it at that, you're going to have approximate, let's say, just $50,000 worth of closing costs. You get to subtract that. Also, you get to subtract capital improvements. Now you need to verify this with your accountant and specifically what capital improvements are. We're not talking about maintenance, we're talking about capital improvements. If you've done that, you can subtract, let's say in this case, $20,000 worth of capital improvements. If my math is correct, it puts us at $330,000. Now, two scenarios, and this is a key factor. This will save you from a lot of capital gains taxes. So you need to understand the timing of this. So we've got two scenarios. We're down to $330,000 here, $330,000 here. We're talking today about your primary residence, meaning if you have lived in the property 2 of the last 5 years, then you're protected for worth $250,000. So 330 then minus 250,000 puts you at 80,000 that you'd pay capital gains on this 80,000 only. Now, if you're married and both parties have lived in the property 2 of the last 5 years, then you get 500,000. So that puts you at then negative 170,000. In that case, you wouldn't pay any capital gains when you shift your money from one property to the next. Why is this so important? It has a lot to do with timing. I mean, if you were looking to sell your property at 1 year and 10 months and you sold it before 2 years, then you're going to pay a lot more capital gains. You're not going to have this $250,000 or $500,000 worth of protection. So it's important to really, when you think about selling a property, to look at the timing and to make certain you consider capital gains, because you want to figure out as close as possible how much money are you going to take from this current purchase to the next purchase. And if it means waiting a couple extra months to protect you from that much in capital gains, it's well worth it. Now, next topic that we're going to cover on the next video is going to have to do with a step up in value. This is really important and it really helps a lot of people in certain situations. I'll explain it in the next video. In the meantime, hopefully this information is helpful. Use the links at the bottom of the email if you're looking to search for homes for sale or trying to get the value and accurate value of your current property when you're looking to sell it. Use those links. Let us provide resources for you. Don't ever hesitate to continue sending us your questions that we'll cover in the next video. In the meantime, make it a great day and we'll see you on the next one.